Somewhere in China, in late 2019, a group of people sat down to watch 11,000 hours of store footage. Not for fun. They were counting cups of coffee, one store at a time, one customer at a time. They were convinced one of the most successful companies in the country was lying, and they were going to prove it with a stopwatch. This is the story of Luckin Coffee, how it grew faster than Starbucks, faked hundreds of millions of dollars in sales, and ended up at the center of a fight between Washington and Beijing. Luckin started in 2017 in Beijing. The idea was simple and modern. You ordered on an app, skipped the line, and picked up a cheap, decent latte, often at 30 or 50% off. No cash, no waiting. It worked. In about 2 years, Luckin opened more than 4,000 stores across China. For comparison, Starbucks had been in the country since 1999, and after 2 decades it had around 4,300. Luckin reached that in 2 years, and the investment money came in just as quickly. In May 2019, Luckin listed on the Nasdaq in New York under the ticker LK. It raised around $560 million. Big-name investors had already backed it: BlackRock, the Singapore state fund GIC, and a Chinese private equity firm called Centurium Capital. In January 2020, with the stock near $42, Luckin sold new shares and took on new debt. That raised hundreds of millions more. Across the whole stretch that America's financial regulator, the Securities and Exchange Commission, would later call fraudulent, Luckin raised more than $860 million from investors. Real money handed to a company whose growth was partly invented. Keep that number in mind, as it will matter later. So what was actually fake? According to the SEC's complaint, filed in December 2020, Luckin fabricated more than $300 million in retail sales between April 2019 and January 2020. Not quite a rounding error. That was about a third of the sales it reported in that window. The SEC put a sharper number on it. For the quarter ending in June 2019, the agency said Luckin had overstated its revenue by about 28%. For the quarter ending that September, by 45%. So for 3 months of 2019, almost half of the coffee revenue Luckin reported to investors had never really been earned. The plan, the SEC alleged, had 3 parts. First, invent the sales. Second, invent the cost to match, so the books would balance. Third, build records to make all of it look real. Let's start with the sales. The SEC says Luckin created false sales through related parties in 3 separate purchasing schemes. In plain terms, companies connected to Luckin's own people placed large orders that looked like ordinary customers buying coffee. The cups never moved. The sales went onto the books as revenue all the same. Chinese regulators later described the same thing in more detail. China's market regulator, the State Administration for Market Regulation, found that Luckin and a network of helper companies had generated 123 million fake coffee voucher orders. 123 million orders for coffee that no one actually drank. To make those orders hold up, the regulator said, the group faked transactions, forged bank statements, built a fake database, and forged the records of vouchers being used. Fake demand with a full set of fake paperwork behind it. Then there was the cost side. A company that suddenly sells far more coffee has to buy far more milk and cups, and hire far more staff. So Luckin's helpers inflated those too. The SEC says the company inflated its expenses by more than $190 million. The Chinese regulator described fake purchases of raw materials, fake outside labor, and fake advertising. Invented costs to cover the invented sales. So that was the shape of it. Fake customers on one side, fake bills on the other, and a fake database in the middle to tie them together. From the outside, a coffee company growing at a pace the market had rarely seen. Underneath, a real business with an invented one built on top of it. For a while, it all held together. The stock kept climbing. Then it ran into the people from the start of this story. At the end of January 2020, a financial research firm called Muddy Waters published an anonymous report. Muddy Waters, founded in 2010 by an activist short seller named Carson Block, had built a reputation on Wall Street for digging into public companies and accusing them of fraud. The report ran 89 pages. Block hadn't written it himself. Someone had sent it to him, and whoever they were, they had done something truly absurd to check whether Luckin was really selling as much coffee as it claimed. All they did was count. For over 11,000 hours. According to the report, the authors had hired a small army to sit in and around Luckin stores. 92 full-time people, and more than 1,400 part-timers. They recorded 11,260 hours of store footage across 981 store days. They kept 25,843 customer receipts. Then they compared what they had counted with what Luckin was telling investors. To this day, the people who did that work have never been publicly named. The gap was huge. On average, the report said, Luckin had overstated the number of items each store sold per day by 69% in one quarter and by 88% in the next. The growth Luckin had been showing was real coffee being sold, mixed with invented coffee. And a lot of it was invented. For about 2 months, almost nothing happened. The report barely moved the stock. So what finally exposed the fraud? It wasn't Block and his firm, or any other short seller for that matter. In the end, it was Luckin's own auditors. During the audit of Luckin's 2019 accounts, the company's outside accountants kept running into numbers that did not add up. Luckin's own board set up a special committee to look into it. And on the 2nd of April 2020, Luckin told the world what that committee had found. The company said that about 2.2 billion yuan in sales, roughly $310 million, had been fabricated. It said the scheme had been run by its own chief operating officer, Jian Liu, and a group of employees who worked under him. Note who was talking there. That was Luckin, naming its own executives. The stock did what you would expect. In a single day, it fell by about 75%, from around $26 a share to about $6. Within a week, Nasdaq suspended trading in it. By the middle of July 2020, barely 14 months after its New York IPO, Luckin's shares were removed from the exchange for good. The company that had been China's great growth story was now its biggest warning. Quick side note, while we're here, we're a new channel, and we're not a regular business news channel. We don't chase the big famous scandals everyone has already covered. We go after the foreign fraud cases that never got much attention, and we tell the whole story. That can take a lot of time, so if you're enjoying this one, please consider liking the video and subscribing. It helps the channel out a lot. We cover a different foreign fraud case like this every week, and there are many more coming. Now back to the video. After the dust settled, the reckoning did not take long, and it came in 2 countries. In December 2020, the SEC charged Luckin Coffee with fraud. It said the company had lied to its investors, faked its financial reports, falsified its books, and ignored the internal controls that are meant to catch exactly this kind of thing. Without admitting or denying the charges, Luckin agreed to pay a penalty of $180 million. Separately, it paid another $175 million to settle a lawsuit brought by its own shareholders, the investors who had bought the stock while it was inflated and lost money when the fraud came out. In China, the country's market regulator went after the whole network. It penalized 45 companies tied to the scheme, with fines adding up to about 61 million yuan. Luckin had not pulled this off by itself. It took a crowd of helper firms to make the fake orders look like a real market, and there was a wider cost, one that landed on companies that had nothing to do with coffee. For years, American regulators had not been allowed to fully inspect the audits of Chinese firms listed in the U.S. Luckin became the example that forced the issue. In 2020, Congress passed a new law, the Holding Foreign Companies Accountable Act. Under it, if a U.S.-listed company's auditor cannot be checked by American regulators for 3 years in a row, the company is removed from the U.S. stock exchange. Around 200 Chinese companies were suddenly facing that deadline. One fake coffee chain had helped rewrite the rules for all of them. What happened next doesn't fit the usual fraud story. Luckin survived. Then it did a lot better than survive. A Chinese private equity firm called Centurium Capital, one of the investors that had backed Luckin early, took control of the company. It bought out the old founders, restructured the debt, and kept the stores open. Luckin filed for bankruptcy protection in the United States, and in April 2022, it emerged from bankruptcy. In the coffee business, the real one underneath the fake numbers kept growing. By 2023, Luckin was bringing in more revenue in China than Starbucks. This time it was real. Real stores, real sales, and more of them than Starbucks, the company Luckin had once only pretended to rival. Charles Liu, the co-founder forced out after the collapse, didn't leave the business. He started a rival coffee chain called Coffee and went to war on price, selling drinks for as little as 9.9 yuan, a little over $1. Coffee opened around 5,000 stores in 9 months, and the price war it started helped push Luckin to its first quarterly loss in years. By 2025, Luckin was opening its first stores in the United States, in New York, and getting ready, carefully, to list on an American exchange again. A fraud that faked hundreds of millions of dollars in sales had nearly destroyed the company. It survived, and then it grew. By the end of 2024, Luckin was running more than 22,000 stores, with revenue of more than $4.5 billion a year, well past where it had been before the fraud. Coffee, the chain Charles Liu built after he was forced out, had grown fast as well, to around 10,000 stores. But the company he had once run was still about twice that size. He was right across the street, selling cheaper coffee, chasing the business he used to own. So what is the lesson here? The product was real. People liked the app and the cheap latte, and the stores really did fill up. The fraud was built on top of that to make the company look bigger and growing faster than it really was. The part worth remembering is older than Luckin. Audited numbers can still be fiction. A company can show you revenue, growth, even a database full of orders, and every piece of it can be staged. The one thing that is hard to fake is whether the cash behaves like cash. Luckin's didn't. And in the end, it took an anonymous team counting cups across 11,000 hours of store footage to force the question into the open. Whether the next Luckin gets caught this quickly, well, that is the open question. The numbers will always look clean. Someone still has to go and count. That's it for this one. If you got something out of it, drop a like. It genuinely helps the channel reach people who'd want this. Subscribe if you want more foreign fraud cases, and if you want to support the work directly, we're on Patreon, where members get new videos early before they go public. The link's in the description. Thanks for watching. We'll see you on the next one.